Zed Francis is with us, CIO of Convexitas. Thank you for being here, Zed. I wanted to talk with you to talk about what we've been seeing in bonds. I mean, for example, today you're seeing Treasury yields higher. You have the 10-year back above 4%. Last week, a different picture. You had bonds rallying. Those yields were pulling back. What do you attribute the moves that we saw last week and the reversal that we're seeing now? And is this a typical recessionary sign in your mind?
Hey, afternoon, Nicole. Before get into that, I'm surprised Oliver's not here. Everybody out back said that his flight got canceled, but I'm pretty confident he just looked at the weather here in Chicago and decided to stay in Florida. But yes, it's been a tale of 2 weeks for fixed income already, even the 1 day into this week thus far. I think really last week was the market finally saying that they don't actually think the Fed is data dependent, that it's very much they're on a track to get things back towards a neutral stance, whether that's kind of like mid threes or low fours in terms of the front end. And as long as there's not massive spikes in inflation, that's the train that they're on for the moment. And I think a lot of that actually has to do with the refinancing cycle. There's a decent wall of lower grade, high yield, whether it's in the publicly traded or private markets, that are kind of hitting that wall of refinancing that they originally issued a decent amount of debt late 2020, early 2021, when obviously rates were much lower, and at that point in time, credit spreads had tightened a good bit, and they need to come back to market here. And the Fed, I think, is a little bit nervous that if a decent amount of these folks are unable to refinance, that it could actually lead to substantial job loss. So I think they're a little bit on the move unless we see a significant increase in inflation at this point.
Look, I mean, that's part of that also would be something like commercial real estate. You have a lot of those loans that are coming due, right? And they would like to refinance, rework those loans, but they're not able to do the leases, for example. They're not able to do those because of the high rate environment, to your point, hitting a wall. Yeah. And that really could stall the economy. And that part probably could be part of the Fed's lag effect that they're still waiting for. So in your mind, are you worried about this? Because you're talking about job losses, you're talking about hitting a wall, and that's sort of somewhat of a credit crunch. Are you worried about a recession?
I think live, not necessarily here. Commercial real estate is obviously a problem, but it's much easier to amend and extend commercial real estate because we all know the folks that are actually sitting on the other side of these loans have a little bit more leeway in terms of providing a little bit of relief. Nobody wants to take the keys on properties, so you have a very standard amend and extend environment. But for smaller companies that need the financing because they're free cash flow negative from operations to continue employment, those kind of levers aren't necessarily there. So I think ultimately there's a little bit more worry from an unemployment standpoint from possible, high-risker corporates not being able to find financing, although obviously the commercial real estate problem is very much there.
Mm-hmm. So that being said, what do you think about what we're seeing from the bank earnings, and what does this tell us about the financial system? Of course, we had the regional banks, which blew up in last March, and everybody's really honing in on some of the regional banks for this week. What are you hoping to learn, and how are you feeling overall? I mean, what is your vibe about, we've crossed into the new year, what is your vibe thus far, based on what you're hearing for 2024?
Yes, I think there's two different pieces. So the market reaction week 1 versus week 2 of 2024, I think was way more like standard calendar effects, right? I mean, we had a pretty substantial rally last year. I think folks probably wanted to do some rebalancing in portfolios, especially from the outperformers. But nobody would rather sell once the calendar flips over to pay the tax bill come spring 2025 rather than 2024. So I think that was a lot of the first week of the year. It was essentially the tax effect of folks doing the rebalancing. They would have probably done a little earlier, but said, hey, let's go ahead and delay the tax application of that rebalancing effects until the new year. And then the second week, you basically had the unwind of that. We had a little bit of a sell-off, 1.5% in the S&P, a little bit tech-led, and then the reversal essentially happened last week to get us back towards neutral. So I think broad market was really driven from a little bit of the calendar effects and tax management. In terms of banking sector, I find it really interesting that we continue to creep up, and maybe even over the last month or so, accelerate the bank term funding program that the Fed launched last March to kind of stem the crisis at that point in time. Because ultimately they created this program as a bridge, right? We have a little liquidity problem. We need to provide liquidity to these banks. Once things settle in theory, then they should be able to go back to the market and refinance, what they need to and get term funding from the marketplace rather than the program. And that's obviously not what we're seeing right now. Now, the curve is definitely shifted. So they're able to borrow from this program as of last Friday at like 4.9%. So that's cheaper financing than a lot of other places outside of deposits. That would probably be cheaper than other places. So it's a little bit of possible funding gain going on. But ultimately, you'd think that these regional banks that have been tapping this program would utilize the really tight credit spread environment that we're currently in to go ahead and get out of this kind of floating rate program and issue 2s, 5s, 10s to go ahead and bridge a longer term liquidity gap than where we're currently sitting. And also the FOMC is starting to communicate that this program's not going to be here forever. They haven't actually said what the plan is, but they've indicated that it might be over in March, a year after the initial launch of it. Now, I highly doubt that they're going to essentially liquidate the program. They might not let it grow any further at that point in time, but they also don't want to message that now, because if you told somebody that their ability to achieve this cheaper than market financing is closing in 2 months, they probably go aggressive to go ahead and build extra positions in there. But it'll be interesting to see the communication over the next 2 months of what they're going to actually do to unwind this program.
Right, and so if that goes away in March, obviously you're talking about how it may go, there's no real clarity how that may end, if any, or part of it. As to your point, it was meant to be a bridge loan, somewhat of a Band-Aid, but the fact that things haven't rolled or happened the way they're supposed to, that may worry you. In the meantime, we're getting a lot of Fed speak this week. We've gotten in our CPI and PPI prints. The Fed is likely to do 3 cuts, maybe more this year. Final thoughts, Zed?
Yeah, I mean, I think the real interesting thing for me this year is going to be, as the Fed likely starts some sort of cutting process, we'll see how aggressive it is what does the long end do? I'm way more interested to see if the curve continues to steepen dramatically, as in we know there's a significant amount of issuance that needs to take place from Treasury, and the Fed has much better control over the front end of the curve than the long end of the curve. And if they start cutting into something that still feels like a reasonably strong economy, does the long end of the curve sell off aggressively into that? Do we get to 5 handles back in 10 and 30 years, even though they're cutting on the front end?
All right, so we'll watch for that. Zed, good to chat with you. Thank you, Zed Francis of Convexitas.